Hey there, welcome back to topic 3 of stock trading for beginner series. As part of technical analysis in topic 2, we looked at price charts, various chart patterns, market trends, and how they can be used to interpret the behavior of the markets to give you an indication of how a stock price is likely to behave in the future. Today, let's kick off the last component of technical analysis, that is technical indicators. First, what are technical indicators? Technical indicators are signals that are derived from the price movements using mathematical calculations. There are just too many of these indicators. As a beginner, you probably only need all of them. In this video, we are only going to look at moving average, the most widely used technical indicator. So, when you look at a price chart, it's a series of zigzags. Price moves up and down over a period of time. But how do you determine a buy or a sell signal? Because if you look at the price chart on its own here, it can often lead to false signals. If you bought at these levels thinking the price would go up further, you can see how it actually tanked. And if you sold at this point thinking it would fall further, the stock actually went up. Now, this is where technical indicators such as moving averages can help find the trends by tuning out the noise from random price fluctuations and smooth out the price. Moving average in simple terms calculates the average price of a stock over a period of time to identify trends, determine support and resistance levels, and confirm trend reversals. Time frame can be any period that you wish to specify, but the most commonly used time frames are 10, 20, 50, 100, and 200 days. It will all make sense when we look at a few examples. Here I've taken a price chart with a 200 period moving average. This red line here is the moving average. As you can see, when the price is above the moving average, it signals an uptrend indicating a buy signal. And when the price moves below the moving average, it signals a downtrend indicating a sell signal. When the price candle crosses the moving average, which is called break-in of the moving average, like here and here in this example, there appears a reversal in trend. Here the price moved upwards, crossing the moving average, signaling an uptrend. And here the price moved downwards, breaking the moving average, signaling a downtrend. Sometimes moving average can act as an area of support or resistance. Let's look at an example. Here, the price is seen hitting the moving average a few times, but bouncing back, unable to break it, causing this area of resistance, signaling a downtrend. Conversely, here the price is seen dropping down to moving average, but unable to break it, causing this area of support, signaling an uptrend. So essentially, a moving average can indicate if the stock price is trending up or down, or if there is a trend reversal. Next, let's look at types of moving averages. There are two main types: simple moving average, also known as SMA, and exponential moving average, also known as EMA. Let's first look at simple moving average. Suppose you want to plot a 20-day simple moving average. This is done by adding up the closing prices for the last 20 days and then dividing that by 20 to get the average price, which is then joined to get a simple moving average like so. Since it's a moving average, the time frame is always adjusted by dropping the oldest day and adding the new day. So in our example, the system will only take the last 20 days by dropping each day as we move along. In real life, you don't have to do any of these calculations manually. Fortunately, all of it is done automatically by the trading application when you choose the option of your choice. Simple moving average takes the average closing price of a stock over a specified period. It essentially means equal weight is given to all days within the specified time frame, making it slower to react to rapid price movements. For example, day 20 counts as much as day 1. Due to this, when a stock experiences a huge pullback or large bounce, the moving average can take some time to reflect, causing a lag. Here, as you can see, the price started falling much before the SMA could react, and this can lead to false signals. And that is where the second type of moving average, the exponential moving average, comes into play. Basically, exponential moving average is similar to the simple moving average with only one significant difference, that is the weight given to the time frame. EMA gives more weight to recent periods, leading to quicker response to price actions and trends, while SMA gives equal weights to all days, making it slower to react. Let's look at a side-by-side comparison of a 20-day simple moving average and exponential moving average. Here you can see how the EMA is closer to the average price than SMA, making EMA more reliable. Right, now that you know a fair bit about moving averages, here are some quick tips on choosing the right time frame and right type of moving average to gain the maximum benefit. For shorter time frames, such as 10 or 20 days, use exponential moving average as they identify short-term trends and also analyze fast-moving price actions by giving more weight to the last prices. Simple moving average for shorter time frames, such as 10 or 20 days, can lead to something called whipsaws, causing the price to cross over the moving average too quickly, giving false signals. Basically, when the market is choppy, shorter time frame SMAs can give too many buy or sell signals, something like this. So an EMA is much more reliable and accurate here. However, for longer time frames, such as 50 and 200 day, use simple moving average as they identify mid to long-term trends, particularly if you are a position trader holding for a longer period of time. Exponential moving average can be slightly misleading for longer time frames, giving false signals. Now, moving average in general is based on past prices and is known as a lagging indicator. This means it's slow to react and it won't warn a price action accurately in advance, but can confirm a trend reversal. Well, that brings us to the end of today's session. While it's far from a complete guide and only intended at providing some basics on moving average for beginners without it being too overwhelming, nonetheless, I hope I was able to provide useful insight to set you in the right direction. I hope to see you in the next one. Take care.